Hey everybody, Smart Silver Stacker here. Hope you're doing well. Welcome to another live stream. Looks like it's time to sell your gold and silver, everybody. Of course, I don't actually believe that, but that does seem to be the prevailing sentiment among investors today following the release of the Bureau of Labor Statistics better than expected non-farm payroll numbers for January. Now, it's not like the metals are getting crushed today, but they did both sell off pretty sharply. We got the price of gold, as you can see here, down a little less than 1%. Very similar story in the price of silver. So again, not like the metals are really getting killed. Silver down about 1.85%, but you can see from that chart there was that very sharp sell-off today on the release of those non-farm payroll numbers. The U.S. economy, according to the Bureau of Labor Statistics, adding 353,000 jobs in the month of January. That's against expectations of 185,000, so a huge beat on jobs. The narrative here, of course, is that the U.S. economy is doing great. It's super strong. We've got all these great jobs being added. What could go wrong? The Fed's not even going to need to print. They might as well just keep rates elevated because the economy is so strong. This is the narrative that investors must be believing, considering the fact that the metals are selling off on this news. In fact, you can see here from the CME FedWatch tool that now we are expecting about a 20% chance that the Fed is going to cut rates at their March meeting. This is down from over 80% last December. Just about a month ago, we had investors clamoring for rate cuts in March. Of course, that's because Jerome Powell basically told us that was coming. He told us in December to expect rate cuts in 2024. Now, we're still going to get those rate cuts regardless of these job numbers. And real quick, do me a favor. If you think that these job numbers have any bearing on reality, put a 1 in the chat. If you think that they're cooked and they're supporting a fake narrative, put a 2, because if you ask me, that's what's going on here. Almost certainly this number will be revised lower, just like all of the other months that we have seen. The non-farm payroll report, I think it's like the past 10 months out of 12 that it's been revised lower, and they're trying to paint a very rosy picture here. It's all perception controlled. Now, it's looking like, according to the FedWatch tool, we're going to have to wait until May to get the rate cut. But the thing is, a lot can happen between now and even that March meeting. We still have a U.S. economy that is plagued by a variety of problems, and yet the sentiment towards the precious metals is absolutely in the toilet. These things, you got to keep in mind, these are safe haven assets, right? Especially physical gold and silver. And, it's clear that the spot price is dropping, but physical demand is down too. These are some Australian kangaroos. I just picked these up from SD Bullion. Got another half tube here. And I paid $1.59 over the spot price for those kangaroos. So we've seen premiums come down. This means there's less interest in physical. I've heard many reports from those of you out there from local coin shops saying that there's a lot of people coming in and selling their metals. Now, this could be because people don't think they need the safe haven aspect of the metals. It could also be because everybody's getting broke, and they need the money. I think that's really what is triggering the sell-off to the extent that we're seeing it in physical metals. But, it's just incredible, the sentiment towards the metals, considering the fact that we're in the midst of a massive banking crisis, which has not been resolved. We're in the midst of what's likely to become a global war. Let's just talk about the banks real quick. Let's talk about the banks. We have New York Community Bank Corp. If we recall, just a couple days ago, the share price of this regional bank, they're the ones who absorbed, I think it was Signature Bank that they bought up in March of last year. They took on all those troubled assets. And now on their commercial real estate portfolio, they're seeing these huge increase in delinquent loans, in charge-offs. You can see here That's what we witnessed earlier this week. That huge sell-off to the about 30%, 36%, I think, in one day. The price of this regional bank sold. Now they're bouncing back a little bit today, you can see, but I don't think that we've seen the bottom for these regional banks yet. And yet everybody forgets this. You just get one day where you get a government non-farm payroll report better than expected. Surprise, surprise. That the government giving itself an A on its own report card. I mean, that is essentially the dynamic here. You've got the government reporting their own progress on the economy. Obviously, there's a lot of room, especially in an election year, for manipulation, massaging of this data. But the reality is that, whatever the jobs report says, the Fed is going to have to get out there and print a lot of money to bail out these regional banks, to bail out commercial real estate. I mean, that problem has not been resolved. A lot of these commercial real estate properties are worth far less than they say on paper because the amount of buyers have dwindled dramatically because of higher interest rates. So the Fed is going to have to get in these markets and intervene. I mean, the US national debt, $34.2 trillion now almost. I mean, we'll be there probably in a day. 34.2 trillion. The interest on the national debt now exceeds $1 trillion. This is all a problem brought about by these elevated rates. Now, it's not like rates are extremely high by any normal, quote unquote, normal measures. 5% federal funds rate is not extremely restrictive. Yeah, it's not quite as easy as zero, but already the cracks are starting to show, and yet investors seem to be ignoring this. A lot of people seem to be buying into the mainstream narrative. You know where any money is flowing? It's not flowing into the precious metals. But look at this. You got Meta today on their earnings report up over 20%. So yeah, you are seeing actually the stocks in the green today. 3 out of the 4 major stock indexes here. You get the S&P, the Dow, and the NASDAQ all in the green. Russell 2000 slightly in the red, but it's really gold and silver that are experiencing this pain. But think about this. I mean, think about where this money is going. Most of the increases on the major stock indexes are concentrated in a few darling stocks. They get the Majestic 7. That's the new catch term for these things. Meta, one of those, Meta, formerly Facebook. But I mean, all of this money is flowing into these things. Now, Meta's PE ratio right now, 41.84. That is a very rich valuation. Now, does that mean it can't go higher? No, it doesn't. In the 2000 stock bubble, the NASDAQ PE ratio, I think, hit something like 200. So certainly there is room for these bubbles in tech stocks and cryptocurrencies and all of these various assets to increase. But that doesn't mean that they're not bubbles, and that doesn't mean that safe haven assets aren't going to be incredibly important. You want to talk about sentiment in precious metals. This is one of the most telling things. I mean, this is incredible. And, I can tell you personally from, I see someone in the chat here saying, when will I put a Q&A live? Well, feel free to put questions in the chat. If I look at them, I'll answer them. But, just based on the comments that I see on these videos, I can tell you that right now, even among stackers out there, sentiment towards the precious metals is really in the toilet. And look, I get it. There have been a lot of us, myself included, calling for higher gold and silver prices for some time now. I will also say, I'm putting my money where my mouth is. I'm continuing to stack. I'm continuing to accumulate precious metals related assets. I bought some more Newmont mining today, and I want to look at the share price of that. I mean, this is the world's biggest gold miner, down about 3% today. But look at the chart for this thing. If you look at the 5-year chart, you can see that back in April of 2022, Newmont Mining was trading over $80 a share. This is with the gold price actually lower than it is today. And now Newmont's down to $34.46. I mean, this is incredible that this share price has been cut in half with almost no movement in the price of gold. Now, the miners, they do have some additional costs because of inflation, labor costs, input costs, they go up, that affects earnings. But the fact that the miners, the biggest miners, are coming under so much pressure, I think is indicative of investors' view that gold and silver prices will be dropping more in the future. Now, of course, I don't view that to be true. I think the Fed Again, whatever the jobs numbers tell us here, the Fed is going to have to get in and print. But it just tells us how susceptible, one, investors are to this narrative, how much it really is still risk on. I see some people in the chat here saying silver is doing terrible. And yeah, it is. I mean, the price of silver is incredibly cheap right now. Now, of course, I like to buy assets when they're cheap. And, that doesn't apply to all assets. Like just because an asset goes down in price is not a reason to buy it. But I mean, the fundamentals for silver couldn't be better. You've got year on year deficits. We've got deficits in physical metal. The world is consuming more silver than is being produced. You have got a huge amount of geopolitical risk in the environment right now. I think that is not being adequately priced into these markets. You have a huge domestic problem with commercial real estate, with regional banks that are going to need a bailout. You've got rising delinquencies on just about every type of debt. You have a consumer who is completely tapped out, record student loans, record credit card debt, rising delinquencies on those things, record low savings. And yet everybody thinks everything's going to be fine because we get a good government jobs report. Now, a lot of this, is driven potentially by algorithmic trading, by things that just trade on the news. They take things on their face value. But to the extent that that is what is going on, it's a huge opportunity, I think. That's why, I just picked up these silver coins. I just bought some more shares of Newmont today because I'm convinced that ultimately we are going to see much higher prices in gold and silver. Now, when is that going to take place? And I know, again, a lot of people probably are frustrated by the timetable, but look, markets can remain irrational for a long time. That's why I always say, be a strong hand. Don't go out there. Don't buy silver with debt. Don't leverage yourself up. Don't put yourself in a situation where you're going to be forced to sell. Just, today is probably a good day to buy. I'm not giving you financial advice. I'm telling you what I'm looking at doing. But when you see these dips in an asset that is, to me, clearly undervalued, I think it's a huge opportunity to get in there. And, silver could even drop a little bit more. I think that pretty much we're near the bottoms, though. I mean, gold is under pressure, but you notice gold hasn't dropped below 2,000 bucks. I mean, I think it briefly did, the paper price, maybe several weeks ago, but 2000 is the new floor for gold, and it's going to take a major sell-off event, probably a pan market sell-off, to drop gold and silver further from here. I'm not saying that's coming, but I think that is what it would take. However, you can't rule out the possibility of a crisis here. I mean, the banks are insolvent, as we saw with NYCB, their New York Community Bank Corp. There's the possibility for bank failures at any time, just like what we saw in March of 2023. And that could be what it takes to get the Fed to begin cutting here. That is very possible. Historically, it does take a crisis to get the Fed moving. Just look at the great financial crisis. Just look at the 2019 when the Fed started easing, when the overnight lending rates spiked up. But they have shown us their hand that when crises occur, they're going to get into this market and intervene. And the crises this time, I mean, none of those crises were ever addressed. The free market was not allowed to do its thing, and the Fed just papered over those problems. So you can expect them to rear their head once again. And I'm going to take a moment here just to say we've got 195 people in the live stream. I want to say a big thanks to all of you for supporting the channel. Do me a favor, smash that like button. We're at 52 likes right now. If we get it over 100, I would be thrilled. And of course, there's also the fact that we're on the verge of a major war, which is going to drive the national debt, the deficit spending to a new record. This is a story that I thought was interesting from Ledger Insights here. This is about Iran. Interestingly enough, new BRICS member Iran calls for digital currency systems this year. And this shows you the threats that are out there to the US dollar. And, maybe this gives us some insight as to what this conflict in the Middle East is really all about. But I want to read a quote here from Iran's BRICS representatives who said, "In the plans of 2024, I hope these economic and financial pillars, especially banking and financial issues, payment systems, digital currency, common currency, exchanges with national currency, etc., will speed up and become operational." Now, the Russians who are chairing BRICS currently, They're saying that, we need to kind of temper that. But this is the trend, is that these nations, these global South nations, are looking for ways to de-dollarize. They're looking for ways to rely on their national currencies. We've known this for a year or so, that the Iranian central bank is working with the Russian central bank to create a gold-backed digital currency for cross-border transfers. So, look, this is probably why we're about to become embroiled in a war in the Middle East with Iran. You can expect it, and you can expect a lot more inflation as a result. You can expect the Fed to monetize all of the deficit spending that we're going to witness as a result of this conflict. Um, but, the dollar is still the world reserve currency, certainly, but the petrodollar system, which is an underpinning of that status, has never been on shakier ground since its inception in the 1970s. In 1974, when Kissinger and Nixon cooked that up with the Saudis. So, look, we know that the world is heading towards de dollarization. We know that we are facing a massive debt crisis. And to top it all off, you've got the financial system in the US, which has all sorts of problems. Investors think that because, we added some jobs numbers on paper in a report from the BLS, that the Fed's not going to print. I'm here to tell you that that is a misconception. And to the extent that it drives the price of gold and silver lower, well, good for stackers because it gives us an opportunity to get in. And look, yes, timing these markets very difficult. Is the money printing going to continue? Yeah. Is the deficit spending going to continue? Yes. Is the inflation going to continue? Yes. Until we have a financial crisis, which we are headed towards. And this time around, I mean, look at the amount of printing that has gone on in previous rounds of stimulus. Fed balance sheet at about $7.7 trillion right now. They're going to need to print a lot more than that to get us out of this problem. What are the differences now between previous crises and now? I mean, the only difference really is that the system is shakier. There's less buyers for US debt around the world. There's more geopolitical risk than before. The debt levels are dramatically higher. And yet, silver is at half of its price from 2011. And again, I don't give financial advice out there, but just look at the sentiment. Do me a favor, put in the chat, give me a 3 in the chat or in the comments if you're watching this later, if you feel kind of frustrated by the price action in silver. And you can, understand that other stackers are feeling the same way. And I know it from the comments I see, but that is exactly the kind of sentiment you would expect as you reach a market bottom. When everybody is sick of silver, when everybody is sick of gold, when everybody is dumping it, that's the time to move in. And you're seeing that in, the gold market. You've got these central banks, primarily from these global South nations, loading up on gold at a record pace. Now, some stackers, yeah, they're probably divesting themselves of silver here. Maybe they're going and buying shares in Meta. I don't know. Getting the FOMO for the tech sector. You've got these, very high PE ratios in a number of these magnificent seven stocks. You got Nvidia, the AI stocks. That's where a lot of the attention is focused on right now. You don't see anybody really talking about gold and silver right now. I mean, very few people in the mainstream. You see ads everywhere for Bitcoin. I think on some of the articles I was reading today, prepare for this video, I was seeing ads for Bitcoin and cryptocurrency and stuff, but very rarely. I mean, unless you're watching maybe daytime television, cable news or something, you're going to see ads for gold or silver. And those are usually for some kind of numismatic bait and switch scam sales thing anyway. It's not like you're seeing people just talking about gold and silver in the mainstream very much. And that to me is an indication of when you want to get into an asset, when it is very negative sentiment. You got generic stacker here saying still have 10 plus years to hold. Well, maybe. Maybe. I mean, it could be 10 years before we see a currency crisis or a sovereign debt crisis in the US. I think that the odds are significantly in favor of that occurring sooner than 10 years from now. But look, nobody can time the markets, nobody has a crystal ball. I do know that we have a system that is far less healthy than what we are being told. We are being told by the likes of Janet Yellen, by the likes of the president, by the likes of Jerome Powell, inflation is coming down, the economy is strong. Well, look, yeah, it's easy to have inflation coming down when you calculate the figures. The CPI vastly understates the real inflation that people are experiencing. And I don't need to tell you this. I mean, if you are a person who goes to the grocery store, you know that inflation hasn't gone anywhere. Now, I also hear people saying in this time of negative sentiment, gold and silver are not inflation hedges. Well, look, first of all, tell that to anybody who is in Venezuela or Argentina or Turkey, any of these places where gold and silver are successfully protecting purchasing power from the forces of inflation. Currently, the dollar, it's the world reserve currency. You got the Fed in this rate hiking mode trying to bring the U.S. economy to its knees. But it doesn't mean gold and silver aren't inflation hedges. Now, we have seen a lot of assets serve as inflation hedges. We've seen huge increases in paper assets, speculative assets, stocks, tech stocks, cryptocurrencies. All of these things have increased massively in value since the Fed has begun running the printing presses in earnest, really since the great financial crisis when the Fed started expanding its balance sheet through these endless series of quantitative easing. Right now, we're sort of at the tail end of the tapering, the quantitative tightening that the Fed has been undergoing. Now, they kind of tell us they're committed to this, committed to selling down their balance sheet. But that is the message the Fed has to send. You got to understand that the Fed knows that much of what happens in the short term with prices and with inflation expectations can be affected by jawboning the market, by telling us that everything is fine, by telling us that prices are coming down. But in the long run, that doesn't work. And so again, to the extent that this drives the price of gold and silver down because of what comes out of the mouth of a Fed official, like nothing fundamentally has changed here. It's just a buying opportunity, if you ask me. And we should be thankful when Jerome Powell talks and the price of silver falls, because Jerome Powell talking, sure, it affects investors and it affects the algorithms. Doesn't affect the national debt. The debt is still there. We're still spending $2 trillion that we don't have every year. We're still spending $1 trillion in interest on the national debt now, and that number is going to continue increasing until the Fed begins cutting. That is the only way the Fed can bail the system out. I mean, when you have a debt of $34.2 trillion, the only way to pay that off is by running the printing presses. And, the $34.2 trillion is terrible. It's really bad, unpayable, completely unpayable. You also have to factor in the U.S. unfunded liabilities of more than $212 trillion. All the money that the federal government is going to have to spend, that they are already obligated to spend moving forward. I mean, they're bankrupt. Like, there's no more money. And ultimately, there's really only two options. And I think we know which way this is going to go. But there's the option that the government can default on all of these obligations. All the holders of U.S. treasuries out there, they say, hey, look, you're going to get a haircut. You're going to get, paid pennies on the dollar. It's all that we can do. It's the only way we can pay it off. They're not going to do that. All of this debt, all of these obligations are going to be met. And that's probably the worst thing that could possibly happen, because the only way to pay these things is to pay them in currency that has lost all of its purchasing power. I mean, this is no secret. This has been in the works for a long time. Someone says, I always appreciate the financial advice in the chat. I'm assuming that's a joke. I don't provide financial advice, folks. Keep that in mind. And look, everybody's situation is different. If you've got a bunch of credit card debt, if you're having a hard time making ends meet, yeah, don't go out and buy silver. But, it might be a good time to look at getting some hard assets if you are sitting primarily in paper digital assets. For the reason that this debt is going to be paid off in devalued currency as the debt gets monetized, sure, there's that. Also, I mean, gold and silver are real money. One of the things we should watch out here for is these strikes are about to occur against Iran. They've been cooking up some kind of response following that drone attack on that U.S. base that killed some soldiers. Well, I mean, one of the possible scenarios here is that we get involved in cyber warfare. I think that they're saying that most of the targets of U.S. reprisals are going to be in Syria and Iraq, but there may also be targets struck inside of Iran in the sense that we may conduct cyber operations against them. And Iran, keep in mind, they have vowed to retaliate against any U.S. strikes. So, what would that mean to retaliate against a cyber strike? Well, it would probably mean a cyber attack on the U.S., something we've been hearing the World Economic Forum warning about profusely for over a year now. I'm just saying, it might be a good idea to have some physical assets outside of the banking system. With the amount of uncertainty out there right now, it's important to have assets without counterparty risk. I mean, even if you got money in the banks, uh, if you're not sitting in one of the giant banks, if you're in a regional bank, it might come down to the fact that this bank doesn't need to get bailed out because it's not deemed systemically important. So, if you're sitting on more than $250,000 in a regional bank account, look, I'm not telling you to do anything. In fact, if I were to do that, I imagine the algorithm might try to scrub this video, even talking about these subjects. They've got in the UK now, or in the EU, a department that is monitoring social media for information that could lead to bank runs. I mean, why do you think they're doing that? It's because the whole financial system is on incredibly shaky ground. And look, if you had more than the FDIC insured amount, I'm sure you'd be sweating a little bit right now watching what's going on in the regional banks. And that's part of why depositors are pulling the money from them and putting it into the banks that are deemed too big to fail. And that's a contributing problem to the banking crisis that we are witnessing. So, I mean, this one's kind of rambly, I guess, this live stream. I'm just kind of touching on a lot of things. But the price action in gold and silver today is just indicative of how out of touch markets really are with what is going on. And to me, again, this is an advantage for stackers, for people who are actually paying attention, who understand the value of real money. Now, when is it going to pay off to hold these things? I mean, I don't know. Gold and silver are a long-term play. They're not a get-rich-quick scheme. Don't expect massive gains overnight. However, I will say this, that when the crisis occurs that finally exposes the nature of this debt-based system, I expect the holders of physical precious metals especially to do quite well. And also those companies that produce these things, I think, will also see a significant increase in their earnings, and that the fire sale prices that they're going for right now are kind of crazy. But that's my take on it. That's where I see things going. We've got a major crisis brewing. We've got a global conflict. The fact that safe haven assets are not in vogue right now, it's a great time to move into them. I'm kind of a contrarian at heart, but that is my thought. So that's it for today's live stream. Thanks for watching, everybody. Let me know what you think in the comments down below. Stay safe, everybody. Happy stacking, and I will catch you next time. Smart Silver Stacker out.